The most significant financial force on the planet is shifting direction. The global monetary policy tide, which has been defined by inflation-fighting aggression for years, has decisively turned. The world's central banks are no longer asking how high rates need to go. They are now calculating how quickly and how deeply to cut them. The evidence for this paradigm shift is no longer a speculative whisper from the fringes of Wall Street. It is a roaring chorus of data points and institutional analysis. Our thesis is clear. The Federal Reserve is now on the cusp of joining this global easing cycle, and the path forward is not one of tentative, isolated adjustments, but a sequenced campaign. The signal we are tracking points decisively to not one, but 3 interest rate cuts by the end of this year, initiating a monetary pivot of historic proportions. Let's first ground this in the undeniable global context. Year to date, central banks across the developed and emerging world have executed nearly 90 separate rate reductions. This is not a policy trend, it is a policy stampede. The scale and synchronicity of this movement mark the most aggressive coordinated easing since the pandemic response of 2020. From the European Central Bank east to the Bank of Canada, the playbook is being rewritten in real time. These institutions are responding to a clear and present signal, a synchronized global economic slowdown that is trumping lingering inflation anxieties. They are choosing to prioritize growth and employment stability, a classic central bank maneuver to get ahead of a downward spiral. For the Fed, renowned for its data dependence, this creates immense gravitational pull. Operating in a globalized financial system, the Fed rarely moves in stark opposition to its peers for long, lest it invite massive currency volatility and capital flows that destabilize its own objectives. The global wave is therefore the first and most powerful piece of contextual evidence that the Fed's long-held higher for longer stance is untenable. However, the domestic data is now aligning with this global imperative, forming the second pillar of our 3-cut thesis. The most compelling shift is occurring beneath the surface of headline employment numbers. While the unemployment rate remains low, a mosaic of leading indicators is flashing amber. Temporary help services, a classic canary in the coal mine for labor demand, are showing weakness. Most critically, we are hearing directly from the CEOs of major employment-heavy industries, particularly in retail, hospitality, and restaurants. Their message is consistent. Consumer foot traffic is softening, spending is becoming more discretionary, and as a result, hiring plans are being frozen or scaled back. The Federal Reserve's dual mandate charges it with maintaining maximum employment. The emerging cracks in the labor market represent not just an economic data point, but a direct threat to the Fed's core statutory responsibility. To wait for the unemployment rate to rise sharply would be a policy failure. To act preemptively to cushion the fall is their job. This labor market softening provides the necessary domestic cover for a policy reversal. This brings us to the market-implied probabilities, the third and most dynamic pillar. The intelligence embedded in bond markets and prediction platforms like Polymarket is no longer debating if the Fed will cut. It is debating by how much and how soon. As of this analysis, the probability of a rate cut at the imminent September FOMC meeting is overwhelming. But more startling is the rapid pricing in of a 50 basis point 0.5% jumbo cut. This probability has vaulted from near zero to a tangible double-digit percentage in a matter of weeks. This market move is profound. It signals that a significant cohort of sophisticated capital believes the Fed is so far behind the curve that it needs to catch up with a dramatic, attention-grabbing move. Whether the first cut is 25 or 50 basis points, the intent is the same: to shock the system with a clear message that the tightening cycle is over and a new era of accommodation has begun. Following this initial move, the forward guidance and dot plot from the Fed will likely map out a path for 2 additional cuts in the remaining meetings of the year, bringing the total to 3. Finally, we must consider the architectural path beyond 2024. This is not a one-and-done recalibration. Analyst consensus from major institutions is now coalescing around a projection of 5 total rate cuts stretching into the spring of next year. This would represent a 125 basis point reduction in the federal funds rate in under a year. Such a move constitutes a full-blown easing cycle deliberately engineered to lower the cost of capital for businesses, governments, and consumers. It is designed to thaw credit markets, refinance debt, and stimulate investment that has been deferred. For the last 9 months, the market has been in a state of suspended animation, frozen, as we termed it, waiting for this very signal. The announcement of the first cut will be the crack in the ice. The confirmation of a second and third will be the torrent. In conclusion, the case for 2024 rate cuts is built on a convergence of 4 powerful vectors. 1. An irresistible global tide of easing. 2. Emerging domestic labor market fragility that triggers the Fed's mandate. 3. Market pricing that now demands aggressive action. And 4. An institutional roadmap for a sustained easing cycle. This is not a minor technical adjustment. It is the definitive end of the post-pandemic inflation fight and the beginning of a new monetary regime designed to manage a slowdown. The catalyst is no longer a question of if, but of when and how fast. The countdown to the first cut has begun, and its implications will reverberate through every asset class, with crypto positioned at the epicenter of the volatility and opportunity it will unleash. To understand the seismic impact of the impending Federal Reserve pivot, one must first discard the notion of cryptocurrency as a niche, speculative asset class operating in a vacuum. The reality is that digital assets led by Bitcoin and Ethereum have matured into the world's most sensitive and responsive barometers of global liquidity. They are the high beta expression of monetary policy, acting as a pressure valve and a forward-looking antenna for shifts in the cost and availability of capital. The thesis is unequivocal. The launch of a Fed easing cycle is not merely a supportive backdrop for crypto. It is the essential high-octane fuel for a potential supercycle, with Bitcoin targeting $200,000 and Ethereum undergoing a fundamental institutional transformation. The foundational mechanism is the liquidity corridor. When the Federal Reserve cuts interest rates and signals further accommodation, it initiates a chain reaction. First, it reduces the yield on risk-free assets like U.S. Treasuries. This pushes institutional capital, the trillion-dollar portfolios of pension funds, asset managers, and corporations out along the risk spectrum in search of higher returns. This is the search for yield. Second, lower rates decrease the cost of borrowing for investment funds and traders, making leverage cheaper and more attractive. Third, and most psychologically, a dovish pivot signals a regime of financial accommodation from the world's most powerful central bank, reducing perceived systemic risk and encouraging capital deployment. Cryptocurrency markets, with their 24/7 trading, deep liquidity, and asymmetric return potential, are a primary destination for this unleashed capital. The 2020-2021 bull run was, in large part, a textbook demonstration of this phenomenon, ignited by pandemic-era rate cuts and quantitative easing. We are now on the precipice of a second, potentially more powerful, institutional-grade iteration of this playbook. This brings us to the staggering but analytically grounded price target of $200,000 for Bitcoin by year-end. This projection, floated by major fund managers, is not random speculation. It is a function of 3 converging variables. First is the monetary beta multiplier. Historical analysis shows that in periods of Fed easing, Bitcoin's price appreciation has dramatically outpaced traditional risk assets like the NASDAQ. If a traditional easing cycle catalyzes a 20-30% rally in tech stocks, the beta effect on Bitcoin could be a 2x to 3x multiple of that move. From a base near $111,000, this math quickly enters the $200,000 territory. Second is the structural supply shock from the Bitcoin ETF. Unlike 2020, there now exists a regulated, seamless conduit for institutional and advisor-led capital to flow into Bitcoin. These ETF act as perpetual buy engines. In a risk-on environment fueled by cheap money, inflows into these products could accelerate exponentially, creating unprecedented buy-side pressure against Bitcoin's mathematically constrained supply. Third is the narrative and momentum factor. The achievement of a six-figure Bitcoin has already shattered psychological barriers. A move toward $200,000, fueled by clear macro tailwinds, would dominate financial media, pulling in late-stage institutional capital and retail FOMO, fear of missing out, creating a self-reinforcing cycle. However, to focus solely on Bitcoin is to miss the broader, more profound transformation within the digital asset ecosystem. Ethereum is poised for a fundamental re-rating, transitioning from tech bet to financial infrastructure. The easing cycle acts as a catalyst for this by solving Ethereum's key historical constraint: the cost of capital for network participation and innovation. As borrowing costs fall, the economic viability of complex, capital-intensive DeFi, decentralized finance strategies improves. More significantly, it accelerates the single most important trend in crypto: the tokenization of real-world assets, RUA. We are witnessing record-breaking inflows of U.S. Treasury bills, money market funds, and gold onto the Ethereum blockchain. Why? Because in a lower-yield environment, the efficiency gains, fractionalization, and 24/7 settlement offered by blockchain-based tokens become irresistible for asset managers seeking any edge. Ethereum, with its robust security and dominant developer ecosystem, is the prime beneficiary. Its share of the stablecoin market, the lifeblood of crypto trading and the on-ramp for tokenized assets, now commands a staggering 57% dominance. This isn't trading volume. This is the plumbing of a new financial system being built during a liquidity surge. The institutional validation underpinning this thesis is reaching a fever pitch, moving far beyond simple ETF ownership. We are now witnessing strategic treasury maneuvers on a balance sheet scale. Major, publicly traded investment firms are allocating billions of dollars to build dedicated Ethereum treasuries, a long-term bet on the network as a core holding. Specialized corporations are launching with the sole purpose of holding crypto assets and are directly listing on traditional stock exchanges like NASDAQ, creating a new hybrid equity crypto asset class. This is a profound shift. It means mainstream equity investors can gain exposure to crypto's performance through regulated stock tickers, further blurring the lines and facilitating capital flow. The narrative is evolving from "should we have exposure?" to "what is our optimal strategic allocation?" In summary, the connection between Fed policy and crypto markets is direct, powerful, and multi-layered. The easing cycle, 1, opens the liquidity sluice gates, sending capital searching for high beta returns. 2, it supercharges existing catalysts like the Bitcoin ETF, enabling explosive price targets. 3, it solves economic frictions for Ethereum-based financial innovation, accelerating the Roe revolution that grants it intrinsic cash flow adjacent value. 4, it legitimizes and incentivizes monumental institutional balance sheet allocations. This is not a trickle-down effect. It is a tidal wave of capital seeking the most efficient forward-looking receptacle. As the first rate cut lands, it will be the starting pistol for this complex, interconnected race. The assets positioned at the nexus of liquidity, technology, and institutional adoption, Bitcoin as digital gold and Ethereum as financial infrastructure, are not just poised to benefit. They are engineered to thrive in the new monetary environment the Fed is about to create. A pervasive and dangerous narrative currently haunts the mainstream financial discourse, the belief that we are standing at a market peak analogous to the dot-com bubble of 1999 or the financial froth of 2007. Major indices hover near all-time highs. Artificial intelligence dominates headlines as the new transformative theme, and retail enthusiasm is palpable. However, a rigorous data-driven analysis reveals a profoundly different and more opportunistic reality. We are not at the end of a long, exhausting bull market. We are at the beginning of a new, structurally distinct epoch driven by monetary policy, technological adoption, and global realignment. The imminent Fed easing cycle does not represent a desperate attempt to reflate a dying bubble. It is the necessary catalyst for the next phase of a durable expansion, one where crypto transitions from alternative asset to systemic component. The core of this argument lies in a direct historical comparison to the genuine bubble of the late 1990s. That period was characterized by a valuation mania divorced from fundamentals. In 1999, the year preceding the crash, the S&P 500 registered a staggering 35 separate all-time highs. The year before that, 1998, saw 47, and the pivotal year of 1995, the launchpad of that bubble, witnessed an astonishing 77 all-time highs. This was a market in a state of continuous, frenetic, and widespread euphoria. Contrast this with our present moment. While 2024 has been strong, the pace of new highs is measured, not manic. We are orders of magnitude away from the sheer statistical frenzy of the dot-com peak. This is not a market screaming in unsustainable euphoria. It is a market grinding higher on a more selective, fundamentally mixed foundation. The psychological profile is one of cautious optimism, laced with significant fear of a downturn, a sentiment backdrop typical of a market in its mid-cycle, not its terminal phase. This leads to the second and most critical structural differentiator, the role of monetary policy in the economic cycle. In classic bubble formations like 1999 or 2007, the Federal Reserve is typically in a tightening cycle. It is raising interest rates to cool an overheating economy and combat emergent inflation, ultimately pricking the speculative excess. The bubble pops when the cost of capital becomes prohibitive for the most leveraged and speculative players. Our current position is the photographic negative of that setup. The Fed is not tightening into euphoria. It is preparing to ease into emerging fragility. This is a monumental distinction. Rate cuts are not being deployed to reinflate a collapsed bubble. They are being preemptively deployed to cushion a moderating economy and prevent a severe downturn. This turns the traditional bubble script on its head. Liquidity is being injected not at the top of a mania, but at a point of mid-cycle transition, with the explicit goal of extending the cycle's runway. This transforms the nature of the coming liquidity from reckless to stabilizing, and for growth-sensitive assets like crypto, it provides a more sustainable, less volatile thrust. We must then integrate the third dimension, the transformative technological and financial adoption curve. The dot-com bubble was built on speculation about the potential of the internet, with most companies burning cash and few demonstrating viable business models. Today's leading market themes, particularly AI and blockchain, are being built by companies with trillion-dollar balance sheets, massive cash flows, and tangible revenue-generating products. More specifically for crypto, the adoption is moving from retail speculation to institutional infrastructure. This is not 2017's ICO mania. This is BlackRock, Fidelity, and Citigroup building the pipes for tokenized assets. This is sovereign nations and multinational corporations integrating blockchain for settlement and treasury management. We are witnessing the productization and financialization phase of a fundamental technology. An easing cycle accelerates this by lowering the cost for enterprises to fund these strategic initiatives and for institutions to allocate capital to the associated assets. It funds the build-out, not just the speculation. Finally, this inflection point is supercharged by a global geopolitical and monetary realignment. The period ahead is not defined by a singular U.S.-centric narrative. Key shifts such as potential political changes in Japan, a nation with one of the world's largest pools of savings, could pivot its financial policy toward digital asset integration, unlocking a new tidal wave of capital. The global rate-cutting cycle itself creates a synchronized release of liquidity, searching for growth and yield across borders. In this environment, crypto's inherent properties, borderlessness, censorship, resistance, and programmability, transition from ideological novelties to practical utilities for navigating a fragmenting global financial system. The asset class becomes a hedge against monetary debasement and a tool for efficient global capital movement. Therefore, the convergence of these four factors paints the picture of our unique inflection point. 1. Absence of bubble metrics compared to historical manias. 2. A supportive monetary catalyst easing, arriving mid-cycle, not at a speculative peak. 3. Fundamental technological adoption moving into a mature infrastructural phase. And 4. A conducive global landscape of realignment and liquidity seeking new systems. This is not the late-stage decadence of an old regime. It is the early-stage construction of a new one. The coming Fed cuts are the spark for this new phase. They will not merely lift all boats in a final parabolic blow-off time. Instead, they will provide the financial oxygen for a more complex, durable, and differentiated expansion, one where capital flows intelligently into the foundational technologies of the next decade. For strategic investors, this is not a time for fear-based exit. It is a time for discernment and positioning within the new architecture being funded and built before our eyes. The epoch of crypto as a purely speculative side bet is over. The epoch of crypto as an integrated component of a changing global financial system is just beginning, and the Fed is about to fund its next major build phase.